You did everything they told you to. You got the job, you opened the 401k, you put money in the savings account. Maybe you even bought some index funds. And somewhere in the back of your mind, there's this quiet feeling that none of it is actually safe. That one wrong move, one bad year, one policy shift, one number on a screen, and it could all be gone. That feeling isn't paranoia, it's pattern recognition. And in this video, I'm going to show you exactly why that instinct is right and what the people who actually survived history's worst financial collapses were holding instead. There are 4 assets. 3 of them cost money, the 4th costs nothing at all, and the 4th one might be the most powerful of the 4. Stay with me until the end, because the last one is the one almost nobody talks about. October 1929, New York City. 2 men, both middle class, both spent decades building up what they owned. The first is an accountant from Manhattan. Stock portfolio, government bonds, savings account at a well-known bank. His setup checked every box a financial advisor would call responsible, diversified, sensible, safe on paper. The second is a farmer from Kansas, 160 acres of wheat, 20 gold coins in a lockbox, a gift from his father, and a pair of hands that knew how to fix a tractor, patch a roof, and raise livestock. Then the crash hit. Banks shut their doors, bonds turned into wallpaper, the market fell and kept falling. The accountant lost everything, not because he was reckless, not because he made a mistake, but because everything he owned depended on one thing: other people's trust in the system, and that trust broke. The farmer? His land kept growing wheat, his gold held its value, his skills didn't go anywhere, and the people who'd lost everything were now trading family heirlooms for food. He came out of the worst financial crisis in American history richer than he went in. Now here's the part that should make your stomach drop. That same pattern repeated. Weimar Germany, Argentina, 2008, 2020. Every single time, the same categories of assets survived, the same categories got wiped out. This video is about the 4 categories that survived and why they work every time, without exception. Asset 1. Productive land. The oldest one. Not land as a line item on a brokerage statement, not a suburban lot. Productive land, the kind that grows food, holds minerals, or sits on water. Weimar Germany, 1923. Inflation so severe that people were burning paper currency in their stoves because the paper was worth more as fuel than as money. A banker in Berlin, 30 years of savings, couldn't buy a loaf of bread. A pig farmer 40 miles outside the city was trading 1 hog for a grand piano that used to cost that banker 3 months' salary. That's not a metaphor. That's from the historical record. Farmers became the new aristocracy practically overnight. The currency could die. Wheat couldn't. Zimbabwe, 2008, same story. Farmers with land and livestock had something people would trade anything for. Urban workers with savings in Zimbabwean dollars had nothing. And this isn't just modern history. In ancient Rome, there was an unwritten rule. To become a senator, you had to own land, not for tradition, because land was the only form of wealth that couldn't be devalued by an emperor's decree. When the Roman denarius lost 95% of its silver content over 2 centuries, senators with estates still ate. The harvest still came in. The land didn't care what was happening to the coin. In 4,000 years of recorded history, from Mesopotamia to right now, productive land has never gone to zero. Not once. Currencies have, stocks have, bonds have. Land that grows wheat has always been worth exactly as much as wheat was worth, and wheat has always been worth something. Is land perfect? No, it can be confiscated. Zimbabwe, the Soviet Union, Cuba, it's happened. It's illiquid. It takes work, taxes, knowledge. It's not a passive asset. But here's what matters. Bill Gates is the largest private farmland owner in America, 270,000 acres. He's not farming, he's hedging. Institutional funds worldwide are quietly buying agricultural land, not because it's trendy, but because inflation math leaves them no other options. Pay attention to what they do, not what they say. But here's the thing about land. Most people don't have hundreds of thousands of dollars to buy a farm.
So what do people with smaller amounts of capital do when a currency dies? That's where the second asset comes in, and it's been doing one job for 4,000 years. Asset 2. Gold. Before you roll your eyes, this isn't about doomsday bunkers. This is about math, and about how humans actually behave when currencies collapse. When a currency fails, society needs a replacement immediately, not eventually, right now. And for thousands of years, the thing humans default to is gold, not because it's magical, but because everyone recognizes it. You can divide it, you can carry it, and no government on Earth can print more of it. Between 1929 and 1933, the Dow Jones fell 89%. In that same window, shares of Homestake Mining, a gold company, went up 474%. Not because of a genius prediction, because when everything else is collapsing, gold becomes the thing everyone runs toward. 2008, Lehman Brothers collapsed. Gold dipped for 2 weeks. Then it climbed 25% by the end of 2009. 2020, governments printed trillions. Gold hit an all-time high. And right now, this is the part you need to hear. Central banks around the world are buying over 1,000 tons of gold per year, 3 consecutive years, more than double what they bought in the decade before. The very institutions that print paper money are storing their own wealth in the one thing that can't be printed. Watch what they do, not what they say. But gold has real weaknesses. In 1933, Roosevelt signed an executive order making it illegal for American citizens to own gold. People were forced to hand it over at $20.67 an ounce, and then the government repriced it at $35, a 40% haircut with the stroke of a pen. Confiscation is not a theory. It already happened here. And from 1980 to 2000, gold sat flat. If you bought at the 1980 peak, you waited 28 years just to break even. Gold doesn't make you rich in stable times, but it makes you solvent when everyone else is broke. That's a completely different function, and it's exactly why the people who issue paper money are holding more of it today than at any point in the last 30 years. 3 assets in, and you might be thinking, this all sounds great, but I don't have capital for farmland or gold reserves. The third asset doesn't require either of those things in the way you think, and it might be the most overlooked strategy on this entire list. Asset 3. A business with pricing power. Not every business survives a crisis. Most don't. But there's a specific type that doesn't just survive, it comes out stronger. These are businesses that sell things people cannot stop buying regardless of what the economy is doing, and because of that, they get to set the price. Brazil, 1980s, inflation running at thousands of % a year. Supermarket employees were walking the aisles with pricing guns, slapping new stickers over the old ones. The price in the morning was different from the price by lunch, different again by evening. Shoppers were physically running through stores, grabbing items before the tags changed. Companies making cooking oil, flour, medicine, fuel, they raised their prices daily, and people paid, because not buying cooking oil isn't an option. Companies locked into fixed price contracts, they got crushed. The same principle was at work 600 years earlier. Venetian merchants controlled the spice routes from Constantinople to Alexandria. Pepper, cinnamon, cloves, things European nobility couldn't imagine living without. When wars disrupted trade routes and currencies wobbled, spice merchants raised their prices. Buyers had no alternative. 2022, U.S. inflation hit 9.1%. Procter & Gamble raised prices and grew profits. Coca-Cola raised prices and grew profits. Energy companies raised prices and grew profits. Companies with pricing power didn't get hurt by inflation, they made money off it. The Roman Emperor Diocletian learned this the hard way. He issued price ceiling edicts in 301 AD. The penalty for selling above the limit was death. What happened? Merchants stopped selling. Shelves went empty. You can't force people to trade at a loss. Pricing power disappears when a government outlaws it or when technology makes your monopoly irrelevant. Venetian spice traders lost everything when Vasco da Gama sailed around Africa. A single generation, their stranglehold gone. So the asset isn't a specific company, it's a characteristic, the ability to raise prices faster than a currency is losing value, because the buyer has no choice. That characteristic worked in Venice, it worked in Brazil, it works today. Land, gold, pricing power, 3 assets. All of them require capital. You need money to buy a farm. You need money to buy gold. You need capital to build or buy a business. But in every major crisis in the last 4,000 years, there was a group of people who came through the wreckage intact. No land, no gold, no business, no starting capital at all. What did they have?
Asset 4. Skills.
Hungary, 1946. The most extreme hyperinflation ever recorded in human history. Prices doubled every 15 hours. Not every month, not every week, every 15 hours. Government workers on fixed salaries were effectively working for free. By the time a paycheck arrived, it was already worthless. But a skilled plumber who could set his own price for each job, he ate. An electrician who could negotiate payment and food, he fed his family. Factory workers started demanding daily wage adjustments. The people on fixed monthly salaries were essentially providing free labor. And this wasn't new. When Rome's currency turned to junk, the economy didn't stop. People still got sick, pipes still leaked, walls still crumbled. The people who could heal, fix, and build, they got paid, not in worthless coins, in food, clothing, and services, things that held real value. A craftsman with a hammer and a skill set was worth more than an aristocrat sitting on a chest full of currency nobody wanted to accept. Here's what's happening today that almost nobody is connecting. After COVID, the world ran headfirst into a shortage. Electricians, welders, mechanics, plumbers. The average licensed electrician in America is 55 years old. Younger generations move toward offices and screens. The skilled trades are aging out. Meanwhile, AI is beginning to do what it does best, replacing white-collar work. Copywriters, analysts, junior accountants. Jobs that felt bulletproof 5 years ago are now on the chopping block. But AI cannot show up at your house and fix the wiring. It cannot swap out a pipe under your sink. It cannot pour a foundation. The world is headed toward a place where someone with a hands-on skill will be worth more than someone with a degree and a laptop. The wage data is already backing this up. When do skills fail? When they're tied to one specific technology that disappears. The telegraph operator, the typesetter, the horse-drawn carriage driver, brilliant specialists right up until the world moved on. The skills that survive are the ones tied to basic human needs. People will always get sick, pipes will always leak, machines will always break down. Those needs don't go away. Why is this the most powerful of the 4? 0 upfront cost, no money needed, only time and effort. Can't be confiscated. The government can take your land. It has seized gold. It has nationalized businesses. It cannot reach inside your head and take what you know how to do with your hands. Can't be printed. You can create $1 trillion with a keyboard. You cannot create a licensed electrician. Skills are the only one of these 4 assets that's available to every single person on this planet right now. No starting capital, no connections, no permission required. 4 assets, 4,000 years of evidence. Why these 4, and not stocks, not bonds, not crypto, not pension funds backed by government promises? Because every single one of these passed 3 filters that no safe asset in history has ever consistently passed. First, you can't create it out of thin air. You cannot print land, you cannot print gold, you cannot print pricing power, and you cannot print skills. But dollars? You can print those. Bonds? You can print those. And every time someone fires up the press, everything that can be printed loses value, while everything that can't holds. Second, people need it regardless of what the economy is doing. Land feeds. Gold becomes money when other money dies. Pricing power businesses sell what you can't stop buying. Skills solve problems that never disappear. Tech stocks and government bonds backed by $39 trillion in debt don't pass this test. Third, historical precedent. Every single one of these four has worked in every major crisis across 4,000 years. Rome, the Middle Ages, Weimar, the Depression, 2008, 2020. The pattern hasn't broken once. Remember that accountant from Manhattan and that farmer from Kansas? You probably understand something now that wasn't obvious at the start of this video. The accountant wasn't careless. He was careful. He followed every rule he was given. But every single thing he owned depended on the system and on other people's trust in it. The farmer's assets depended on nothing but reality. People need to eat. Gold holds form. A skilled hand still works. Those things don't require trust. They don't require a central bank. They don't require anyone's promise. This isn't about whether a crisis is coming. Nobody knows when or how bad. The question is simpler than that. Do the things you own today pass those three filters? Can they be created out of thin air? Do people actually need them? Have they held up, not in theory, not in a model, but in history? Because when the system cracks, the only thing that matters is what can't be erased by a decree, a printing press, or somebody else's broken promise. Which of these four do you already hold? Drop it in the comments. Most interesting answer gets pinged. I break these patterns down regularly. Subscribe. I'll see you in the next one.